So single lets or buy-to-lets, many people refer to this as being the vanilla or the bread and butter of investing into UK property. And really they're going to form the backbone of most people's property portfolios. I think there's a very good reason for that. And I think buy-to-let generally, or what we call single lets, and an example of that might be we buy an apartment and we rent that apartment out to a young professional, or we buy a house and rent it out to a family. It is really a very good mix of effort versus reward, which is often going to be the theme when we talk about different property types. Generally speaking, in the United Kingdom, single lets get about 4 to 4.5%, 5% on average, which means that they're a great hedge against inflation, but they're also relatively easy to manage. Tenants don't need very much hand-holding in terms of the amount of work that you need to do. And from a regulatory perspective, they tend to be the easiest to get set up and operate effectively. Okay, so HMOs, what does that stand for? It stands for houses of multiple occupancy, or houses in multiple occupancy. HMOs might be where you buy a 5-bedroomed property and each individual room within that property is let out to a separate third party. HMOs are both great and they also come with some downsides as well, so I'll do my best to briefly give you an overview of what those are. I think the first thing to say with HMOs is that they can be incredibly profitable as an asset class. We can rent 5 different rooms out within a property. Each of those are likely to be paying a rent to you that in total is going to be significantly above what you would get if that property was a single family let. I think it's also worth mentioning that HMOs can be a really good hedge against void periods. Void period is where we have an empty property by definition. So of course, if we have a 5-bedroomed HMO, one of those tenants drops out, you're still getting a rent from 4 of the 5 tenants, which is probably still going to be more than enough to cover the mortgage, cover any expenses, and still give you a profit. Equally, for tenants, they can be quite low value in terms of rent. It's of course a lot easier to rent a room within a property than to rent a whole property, and so they're very accessible as an asset class. Now, in terms of some of the downsides, HMOs unfortunately probably come with the most work of all property asset classes. There's a lot of regulation that you need to be aware of, and if you are considering a HMO strategy, I would definitely speak to some of our consultants around what some of those regulatory requirements are. There are a lot of work to manage and maintain. It can also be quite difficult to source financing for HMOs. A lot of the financing that you'll need might be quite specialist. There's a lot of cost involved with converting a HMO back to a single family let, which can affect your ability to be able to sell a HMO on the open market. Therefore, typically, if we do convert a HMO or if we buy a HMO, really the reality is for most people, we are only ever going to be selling that HMO back to another landlord, which might limit your sales market. So of course, they can be incredibly profitable, really good hedges against things like void periods, great assets if you're very rental yield focused, but in terms of kind of managing, operating and reselling those properties, there can be some potential drawbacks there as well. So, purpose-built student accommodation, or PBSA. What is that? So you may have the opportunity to buy into a block of flats or block of apartments that is specifically geared towards being rented to students. That apartment building might have communal facilities, things like gyms, fitness suites, cinema rooms that are purposely geared towards the needs of students. PBSA can be a really, really awesome strategy if you're very, very rental yield focused. They tend to be very high yielding, generating anywhere between 7 and 10% net, which means net of all fees, charges, ground rent, service charge, property management fees. So from a rental yield perspective, they can be immensely profitable. Some of the downsides to PBSA, because they tend to be less than 20 square meters in their size, they're unable to be mortgaged. meaning that by and large, any PBSA type investments that you want to make will likely have to be cash. They tend to be relatively low value, so accessible, anywhere between 60 up to about 130, 140,000 at the very high end of the market, but that will need to be cash. Secondly, the resale market, of course, for a purpose-built student accommodation unit will only ever be an investor. We will never be selling a PBSA type unit to someone who wants to live in that property, or what we call an owner-occupier. So, in summary, PBSA can be a very profitable asset to acquire, particularly if it's managed well, yields in excess of 7% net, which is significantly higher than the market average. But unfortunately, they may be cash only, and that depends on the opportunity that you're looking at, and the resale market for the properties may be somewhat limited. Flipping or adding value. I think this is something that our consultants come across quite a lot. So the concept of flipping is buying a property that's perhaps in need of some renovation work, doing that renovation work, adding value to the property, and then selling it on. Now, I think historically, flipping property, which can be done in a relatively short time frame, assuming you have the right team of builders, architects maybe, alongside you, has always been seen as a very, very profitable strategy. Generally, most flips generate somewhere in the region of 10 to 20% per annum. Sorry, not per annum, in terms of the total amount of return on your investment through the increase in capital gain. However, there are some shortfalls as well. The first one, of course, is that there is a lot of effort required with a flip. You need to have experience with renovating a property, understanding what is likely to be desirable from a reseller value. And there can be quite a lot of tax obligations as well. First of all, when acquiring a property through stamp duty, and then when selling it on through capital gains tax. We need to make sure that the increases in value that we add actually are enough, not just to make a profit, but just to ensure that those costs don't dampen any profit that you make. So with a flip, of course, in summary, they can be a very, very profitable strategy from a capital gain perspective. Adding value can be tremendously rewarding, sometimes to the tune of 10, 20, 30, maybe even 40%, dependent on the price per square foot for that geographical area. But it does come with some downsides as well, i.e. you've got to do the work. There's an awful lot of work to do with a flip. You may need to source building materials, you may need to source labour, you may need architects, you may need to project manage if it's a particularly big renovation. Those things come with costs. And we need to ensure that any profit that we're likely to make from the sale of that property also not only makes us a profit, but can cover the taxation obligations that are now on us as well.